Hi, I'm Erin Brown, Asset Allocation Portfolio Manager at PIMCO. Today I will be discussing how PIMCO is positioning portfolios across global asset classes, as well as other key takeaways from our mid-year asset allocation outlook. I'd like to begin with our overall risk stance in multi-asset portfolios. We see signs of potential soft landing in the global economy, led by continued U.S. growth, with divergent paths for other regions. We also see the risk of persistent inflation, especially in the US. While we are expressing a preference for higher quality exposures across asset classes, we see attractive opportunities to take advantage of regional differentiation across economies, as well as to broaden exposures into assets that may benefit from a rebound in economic activity. Diving deeper into each asset class, we are overweight equities as we believe that re-accelerating global growth should support broader earnings growth. We express a preference for up-in-quality exposures across regions and sectors from a regional perspective, and we emphasize the U.S. over other developed markets. On the other side, we're neutral Europe, amid our expectation for weaker earnings on the back of weaker economic growth, coupled with less insulation from Chinese import competition. Within emerging market equities, we're overweight selective countries in Asia, namely South Korea and Taiwan, as we believe a recovery in semiconductor sales paired with reasonable valuations may support performance going forward. Turning to fixed income, we see opportunities across high-quality exposures in both rates as well as in credit. We're slightly overweight duration given elevated starting yields, which drive the potential capital appreciation. We prefer developed markets like Australia, Canada, and Europe that exhibit lower inflation risks and greater downside growth risks compared to the US. In emerging markets, we're overweight local rates in countries with high real rate exposures and have room to cut. And within credit, we remain invested in high-quality securitized credit, such as senior non-agency mortgage-backed securities, but are more cautious on corporate credit given the tight spread levels today. Looking at real assets, we're broadly neutral as we await further clarity on the near-term path of inflation. While we certainly see upside risks to U.S. inflation, we prefer to take our exposures in inflation through equities, remaining neutral on inflation-linked bonds, gold, and other real assets at this juncture. Lastly, I would like to provide PIMCO's views across currencies in today's environment. Within developed markets, we are overweight the US dollar, given attractive carry, less demanding valuations versus recent history, and a supportive US growth backdrop. We are underweight the euro, amid expectations for weaker economic growth, as well as the potential for greater central bank policy easing. We are overweight the Japanese yen as a safe haven alternative to the US dollar, as we expect that further bank tightening on the policy side from the Bank of Japan will improve the total carry. And in emerging markets, we continue to overweight attractively valued currencies that offer compelling yields.